Summary of The Intelligent Investor by Benjamin Graham, 1949. Introduction. The Intelligent Investor by Benjamin Graham, first published in 1949, is a foundational text in value investing and is often referred to as the Bible of investing. Graham's principles and strategies have guided countless investors, including Warren Buffett, who regards this book as one of his key influences. The book emphasizes the importance of a disciplined, patient, and rational approach to investing. Key concepts and principles. 1. Investment versus speculation ***. Graham distinguishes between investment and speculation. Investment, he asserts, involves thorough analysis, promises safety of principal, and offers an adequate return. Speculation, on the other hand, is about trying to predict price movements without regard for the underlying value of the asset. 2. Mr. Market. Graham introduces the allegory of Mr. Market, a manic depressive figure who offers to buy or sell shares every day. The investor's job is to take advantage of Mr. Market's irrational behavior, buying when prices are unreasonably low and selling when they are excessively high. 3. Margin of safety. One of the cornerstone principles of Graham's philosophy is the margin of safety. This concept involves buying securities at a significant discount to their intrinsic value, thus providing a buffer against errors in analysis or market volatility. 4. Defensive versus enterprising investors ***. Graham categorizes investors into two types, defensive and enterprising. Defensive investors seek to minimize effort and risk, focusing on the preservation of capital and consistent, modest returns. Enterprising investors, meanwhile, are willing to dedicate time and effort to achieve higher returns, often through more aggressive strategies. Part I. Investment Policy. 1. Investment versus speculation. Results to be expected by the intelligent investor ***. The first part of the book deals with the importance of distinguishing between investment and speculation. Graham warns against the allure of quick profits and emphasizes the need for a long-term perspective. 2. The investor and inflation. Graham discusses the impact of inflation on investment returns. He suggests that while stocks offer some protection against inflation due to their inherent growth potential, investors should still be cautious and diversify their portfolios. 3. A century of stock market history. The level of stock prices in early 1972. Reviewing historical market data, Graham illustrates the cyclical nature of the stock market and the importance of maintaining a long-term outlook. Part 2. The defensive investor. 1. The defensive investor and common stocks. Graham outlines strategies for the defensive investor, emphasizing diversification, conservative stock selection, and the importance of focusing on companies with a long history of stable earnings and dividends. 2. Portfolio policy for the enterprising investor, the positive side. For the more enterprising investor, Graham suggests a more active approach, including the purchase of undervalued stocks, arbitrage opportunities, and special situations. 3. The investor and market fluctuations. Graham advises investors to remain emotionally detached from market fluctuations, using them to their advantage rather than reacting impulsively. He reiterates the importance of the margin of safety and long-term thinking. Part 3. The enterprising investor. 1. Stock selection for the defensive investor. Specific criteria for stock selection are provided, such as a minimum current ratio, earnings stability, dividend record, earnings growth, and moderate price-to-earnings ratios. 2. Convertible issues and warrants. Graham explains the complexities and potential benefits of convertible securities and warrants, though he generally advises caution. 3. 4 extremely instructive case histories. Detailed case studies illustrate the application of Graham's principles in real-world scenarios, highlighting both successes and failures to reinforce the lessons. Part 4. General Portfolio Policy. The Defensive Investor. 1. General Portfolio Policy. The Defensive Investor. Graham emphasizes a balanced approach for the defensive investor, suggesting a mix of high-grade bonds and high-quality stocks. The balance between stocks and bonds should be adjusted based on market conditions. 2. The defensive investor and common stocks. Additional guidance is given on selecting common stocks, focusing on blue-chip companies with a proven track record of stability and dividends. 3. Portfolio policy for the enterprising investor. The positive side. For the enterprising investor, Graham discusses the pursuit of undervalued stocks and more active management, while still stressing the importance of thorough analysis and a margin of safety. Part V. The defensive investor and common stocks. 1. Portfolio policy for the enterprising investor. The positive side. Detailed strategies for identifying undervalued stocks are provided, including analysis of financial statements, industry conditions, and management quality. 2. Security analysis for the lay investor. Simplified techniques for analyzing securities are introduced, making it accessible for individual investors without advanced financial knowledge. 3. Stock selection for the enterprising investor. Criteria for selecting stocks, including quantitative and qualitative factors, are discussed. Graham stresses the importance of patience and discipline in stock selection. Part 6. The enterprising investor and market fluctuations. 1. The investor and market fluctuations. Emphasizing the importance of maintaining a calm demeanor in the face of market volatility, Graham advises investors to use market downturns as buying opportunities and to avoid panic selling during market upswings. 2. Convertible issues and warrants. Further analysis of convertible securities and warrants is provided, including their potential risks and rewards. 3. 4 extremely instructive case histories. Graham presents additional case studies to demonstrate the application of his investment principles, reinforcing the lessons learned throughout the book. Conclusion. The intelligent investor. 1. The margin of safety as the central concept of investment. The book concludes with a reiteration of the importance of the margin of safety, emphasizing its role as the bedrock of intelligent investing. 2. Postscript. Graham reflects on the enduring principles of intelligent investing, noting that while market conditions may change, the core tenets of value investing remain timeless. Key takeaways. Discipline and rationality. Successful investing requires discipline and a rational approach, avoiding the emotional pitfalls of greed and fear. Long-term perspective. A long-term outlook is crucial, with a focus on the intrinsic value of investments rather than short-term market movements. Margin of safety. Always invest with a margin of safety to protect against errors in judgment and market volatility. Mr. Market. View the market as a partner offering opportunities rather than a guide to value. Defensive versus enterprising investing ****. Tailor your investment strategy to your risk tolerance and willingness to dedicate time to research and analysis. Graham's The Intelligent Investor remains a seminal work, offering timeless wisdom and practical guidance for both novice and experienced investors. His emphasis on a disciplined, value-oriented approach continues to influence investment strategies to this day.